Next topic is on how does tax reform affect you in this environment of growth. And we've got a team of speakers grounded by a partner and a really good friend of mine, Mike Hess, of my CPA from Grennan Fender. They're going to be talking about what does this mean to you. And Mike's going to be joined by Amy from Swan Hadley and Glyn Griffis from Raymond James. And all I can say is try to stay with it. There's going to be a lot of info and a lot of examples. Feel free to ask questions, but we're going to cut it off if it gets too engaged. So I just want to alert you to that. So Mike, the floor is yours.
All right. Thank you. Good morning. So the purpose of my speaking with you here this morning is to help educate you on the new tax law that got the new Tax Cuts and Jobs Act that got signed into law on December 22nd, 2017. There's a lot of information to cover. We're only going to just kind of glide over the surface. My main objective here is to try to give you in a digestible format some of the highlights of this new tax law. This thing is about 187 pages long, and it's fantastic reading material. But what we did as a firm is we went through that document and pulled out the things that we felt like would be most of most interest to you. So while this isn't a comprehensive coverage of the entire new tax provision, it at least gives you a taste of kind of what to expect for businesses and individuals. We are going to be guided today not only through this conversation by Glyn Griffis. He is with Raymond James, as Jeff pointed out, and then also Amy Collins-Hitchner is the lawyer in the room here from Swan Hadley, who will help us, guide us through the conversation when it comes to legal matters. Okay, so what we're going to learn, I'm just going to briefly go over who I am in our firm, why I'm standing here in front of you today, and then we're going to talk about why we have a new tax act. And then we'll talk about the individuals, how it affects businesses, estates and trusts, and then as time allows for, we'll get into some questions. So why I get up every day, and I love doing accounting, and I love doing tax. And what drives me and the rest of my partners in the firm and our employees is that we strive for our clients to have financial clarity. And that's understanding the tax return they're signing, that's understanding, evaluating their financial statements, and understanding how their businesses operate from a financial standpoint. So that's kind of what our purpose is and what drives us. We've got a lot of experience. We're one of the largest firms in Orlando, and we cover tax, audit, business consulting, and back office accounting services and so forth. So, if you have any questions today, you don't have to remember everything I'm telling you here. You can call us or contact a tax professional to help you understand how these new laws affect you directly, okay? So why do we have a new tax provision? I mean, what brought on all of this discussion, or why do we need a new tax law? Well, if you remember when Reagan was president, he overhauled the entire tax code in 1986. Basically threw out the old, brought in an entirely new one. It got rid of a lot of crazy loopholes and streamlined the tax process, reduced the taxes considerably, and so we had a tax sale during that time, and it was a boom for business. It did a great thing for us, helped the economy a lot, and at that time it made us very competitive in the global market. Since that time, over the past 30 years, what's happened is these other countries, the United Kingdom, Ireland, Russia, they've all lowered their rates over the last 30 years. And we're, in the US, stuck at 35%. So it's made it very hard for companies to compete when your competitor overseas is paying 15% less on income tax. So really the target of this law and what Congress was trying to do was help companies be more competitive in a global marketplace by reducing their rates. And that was sort of the purpose of the law. This is actually just a snapshot of the front page of the tax law, or the new act. And again, it's 187 pages, and great reading. All right, so let's talk about what was the bad news. What are the things what did we lose in this bill, right? Well, we got Likekind exchanges, if you're familiar with those. This is when you have, let's say you had a pickup truck in your business, right? And you had fully depreciated it, and you were going to go trade it in and get another one for your business. And any of the trade-in value would be entirely taxable as gain because you fully depreciated your truck. It's got a zero basis, right? Well, the Likekind exchanges, what was really helpful with that is that you could take that gain instead and roll it into the cost of the new truck and not pay tax on it. Now, if you paid $40,000 for the truck, you're only depreciating $30,000 if you got a $10,000 in a trade-in value. But they did away with that for equipment. No more 1031s for equipment. You could just do them for real estate transactions. So I think that was good that they preserved it for real estate transactions. I'm going to have a heck of a time trying to explain to my clients why they're paying tax on an old pickup truck that they turned in and traded in for a new one. But anyway, so the next, another thing that kind of an important thing, the NOL carryback they did away with. If you know, when you prepare your tax return, if you have a number that's less than zero in taxable income, you could take that loss and you could go back 2 years and amend your tax return from 2 years ago, plug the loss in, and get a tax refund. You can't carry losses back anymore. Instead, you can carry them forward. What they did do was they lifted the 20-year limitation on loss carryforwards and make it indefinite now. So you get to keep if you have an NOL, you can carry it forward indefinitely. Moving expenses used to be if you move more than 50 miles and you had a good work reason why, you could take a deduction for that on your tax return. They removed that provision of the law. Property taxes, you're limited now to $10,000 as part of your itemized deductions. So that's a new thing. Miscellaneous itemized deductions, some of you may be familiar with this. This is when you have business expenses, right? But you're not in an S Corp, or you're not in a C Corp, or you're not a sole proprietor, but you're a W-2 person. And you pay out-of-pocket job expenses, right? Well, if you're not reimbursed for them, there was this place in the tax return you could go to, miscellaneous itemized deductions, and stuff it all in there, and then you get a write-off essentially. Well, no more miscellaneous itemized deductions. They removed that thing completely from the tax law. And this is probably the most painful, and this one affects me personally too. Entertainment expenses, you can't write them off anymore. They removed that completely. So imagine you take your client to lunch, right? And you're talking about business, and you can't write that off anymore. It used to be you could go back to your office, turn in your receipt, and you knew you had a tax deduction. Now you were limited to 50% of entertainment and meals, but at least you got something for it, right? No more. You take your client to a basketball game, and or take golfing outing, that's entertainment. It's not deductible anymore. That's unfortunately a very hard fact that we have to swallow.
And that applies to meals just as much, Mike, or?
Yeah, so meals, typically when I think of entertainment, I mean, a lot of mine is in taking a client to lunch, for example. It used to be I could write off that amount, or at least take 50% of it, right? But no more.
What about for travel?
Excellent question and very articulate. That is still allowable. So let's say we flew out to, you fly out to Arizona and you sit down with a client for lunch. Half of your meal is deductible, but as a travel expense. You're paying for the other guy's meal, not deductible. Yes, sir.
What about membership in a club like the
Nope.
Citrus Club, where you go to meet people, not the food, but the membership?
Right, not deductible. I mean, that's considered entertainment. If you had office space, or if you were renting it for, other things, but club dues were a target. That was one of the things that they wanted to get rid of. And you can tell a lot of what you're going to see here as we go through this. What the IRS is doing, and I'm a little bit sympathetic to it, what they're trying to do is get rid of the crap everybody was doing in their tax returns. All the stuff that was, kind of, iffy. They're trying to eliminate that to make their audits go a little bit smoother. They spend so much time. That miscellaneous itemized deductions was so abused in the tax code. I mean, that was normally the biggest red flag for an audit, was if you had stuff going on in that part of your tax return, and if it jumped outside of their comfort zone in statistics, then they would pull it and take a look at it. Well, it wastes they use a lot of resources to chase these kind of deductions down and to understand them and audit them. So I think what they're doing is they're trying to make the audit process a lot smoother and easier and more efficient. Okay, this is another one. It's a little tricky to digest. Business loan interest is going to be limited to 30% of your income. The way that I guarantee you guys are not the target. Small businesses is not what this tax law is after. So it will probably not affect you. If you have a business loan, you're a traditional kind of company, and you're writing your check for your interest every month, you're probably not going to be harmed by this new rule. The target of this were large corporations that had, just to give you an understanding, if you were a foreign, or if you had a company here in the U.S. and you had a foreign subsidiary in a tax haven that paid no tax, right? You could assign royalties or something to that entity, have it earn a lot of income and not pay any tax, then loan the U.S. company money, so the U.S. company got the cash, and it's not income, not taxable. Then the U.S. company would pay interest back to the tax haven. Tax haven doesn't pay any tax on the interest income, and the U.S. company got a deduction for it. This is shenanigans. Well, they cut that out. So this is kind of what that's targeting. It's trying to fix that problem of people being abusive with some of the tax rules. And so I doubt this is going to affect you. However, I will say you better pay attention to it. Better look if you're a highly leveraged company and you have a lot of debt. This is something we need to look at for you. It's a little bit of a phase in. You get to take EBITDA, multiply EBITDA by 30%, and then that's what you're limited to an interest expense, and then eventually it goes down to EBIT, which will remove the depreciation adjustment in EBITDA. And so it's going to, over a course of time, be a little bit harder of a hurdle to get through to deduct your interest. The exemption for real estate loan, real estate loans. If you buy a house, right? It's you could borrow up to, in the old rules, $1 million. And then you could go out and get a home equity line for $100,000, and you could spend it on a boat, and then you could take a deduction for it on your tax return. Well, now they moved that down to $750,000, including the home equity line. And by the way, if you get a home equity line, if you don't use it to buy the house or make it a substantial improvement to the house, you can't take it as a deduction anymore. Now, if you already have an existing loan in place, and you already did a HELOC, and you already have, if you're over the, up to $1.1 million, you're okay, your loans are grandfathered in to the new rule, and it won't affect you. But going forward, if you go buy a house, if you're gonna borrow more than $750,000, you won't be able to take the interest deduction on that amount over $750,000. Clear? Yeah, good. And then any of you who, this is bad news, the deduction for domestic production activities. If you're a manufacturer, we remember if you're doing manufacturing, you can get to the end of your tax return, multiply the income by 9% and take that as a deduction. They remove that deduction, so that doesn't exist anymore.
Yeah, I was going to mention the real estate losses
Yeah.
for rental property.
Yes,
That was a shocker for me. Because if you pass certain income,
yes,
you can no longer,
that's correct.
so what's the point of having?
Yeah, now those rules, they didn't change, and instead, what you're kind of pointing to is that if you have residential real estate, and you have a loss, once your income exceeds over $150,000, that loss gets suspended in your tax return, and it just sits in there like inventory, waiting for a passive income source to come in to offset it. And but they fortunately they didn't mess with the rules there. They didn't change the income thresholds. So yeah, you'll continue to have suspended losses when you're in the higher income levels. Okay, what survived the new tax law? These are things that are we didn't expect to see make it. We thought they were going to get cut. One thing is AMT for individuals. AMT, it's alternative minimum tax is what it's called, and it's essentially you do your federal tax return just like you always have. In the background, and your tax professional's doing this for you, they're running another tax return inside, and they're adding preference items, subtracting a statutory exemption amount, and doing some calculations at a flat tax rate, and then they compare that result with the federal tax rate, and if the alternative minimum tax calculation's higher, that differential is called AMT tax. That's about the simplest way I can explain it. It's a very complicated thing to follow
There is
and
no
explain.
simple way to explain it.
Yeah, no, it's a messy calculation. But we thought we would lose it. We thought we'd get rid of that damn tax, but it's still here. And but they did take it away for corporations. Regular corporations don't have to deal with it anymore if you're a CCorp. Capital gains and qualified dividends rates. Thanks to President Bush back there, he made sure that we got a really good tax rate. That 15% survived, and so that is unchanged. I don't know if you all remember the SUV loophole, but there was a time where you could go out and buy it. It's a short period of time. It's like a year or two, in 2001 and 2 maybe. You could go buy an SUV and write the whole thing off. So I had clients just showing up at dealerships calling me, hey, I'm going to buy, 3 Expeditions. Can I for my sales team? And they could write them off. They write the whole thing off. Well, Congress didn't like that very much, and they go, well, hang on us, not so fast here. And they came up with this thing called the SUV loophole. They were trying to close it up a little bit, and they're like, well, we'll let you have a little bit of a deduction, but not the whole thing. So you can write off, if you have a 6,000-pound vehicle, you can write off $25,000 the day you buy it, right? And we thought we would lose that one because it's been a thorn in the side of Congress for a while. They're not crazy about that, but it's a popular deduction. So we thought we would lose the hospital tax. This is a 3.8% tax that gets assigned to your investment income when your income's over 200,000 as a single person or 250 as married filing jointly. So if your adjusted gross income's over 250 and you have investment income like dividends and interest, income from a K-1 that you're a passive holder in, all that's subject to a 3.8% tax. That was part of the Obamacare, and they're using that to pay for that health care bill. We were hoping that that would get struck, but they just could not get the votes for it, and it's still with us. If you're on a W-2 and your income goes over 200,000, they start pulling this 0.9. It's the same tax. It's a Medicare tax. They pull 0.9 more out of your check, and the employer matches another 0.9 on your W-2. And that tax continues. And there's no change. If you buy a house for $500,000 and you sell it for $1 million and you're married, you don't pay any tax because you got a $500,000 exclusion, or $250,000 if you're single. That survived and it's still in place. So that's the highlights of what made it through that we thought might get lost. All right. Now this is the personal tax rates. This is the old system, and then this is the new system. And I just want to point out a couple of interesting things about this. The 10% rate, look how it didn't change. See the brackets the same? But after that, everything gets better. So the 15% tax bracket, we lose a couple of points, and so on, all the way down, and it's a graduated tax system. And I always tell my clients when I'm preparing their return, just because you make, in this case, say over 600,000, it doesn't mean all of the 600,000 is taxed at 37%. You still pay on your first, even if you made $10 million, you still pay 10% on the first $19,000. It's a graduated tax system. But you'll notice before the tax rate was 39.6. That's almost 40 cents on the dollar you make. And that's just sickening.
Mike, I have Tax Act trivia. Tax Act trivia for the CPAs in the thing, all right? There are just a small little wedge of people who had a marginal increase in their marginal tax bracket. And unless you can look up there very quickly, who can tell me who are the poor individuals and what spaces that they had to increase in the marginal tax bracket? To me, that was kind of intriguing. Anybody know what it is? It's right in front of you. If you were between $400,000 and $424,950, your marginal tax bracket went up from 33% to 35%. Who did you tick off? That's what I
So
if when you're studying this stuff, you got to find small little things to enjoy.
Thank you. That's a good point. The one other takeaway out of this too is anything over 480 was taxed at the highest tax bracket. Now it's 600. So they moved it up, and they made the brackets wider, except for that one case that you pointed out. All right, now this is the same thing, but for single people. Same rate system, but I want to point out one thing of interest. Notice this. If you're single, you're only hitting this 37% tax bracket once you're over 500,000. If you're married, you hit it when you're 600. So it's a penalty for being married. I try to explain it to my wife, maybe, No, I'm just kidding.
It's a penalty or an incentive?
Yeah, depends on how you look at it, right? Yeah, my wife's a CPA, and she does a completely different kind of accounting and tax. She's a corporate accounting for a Fortune 500 company for Harris. And so she does consolidations and, big time accounting stuff. And she thinks tax is just go multiply it by 37%. And she's always telling me, well, she thinks what I do is go to the office and just multiply things by 37%. Anyway, so okay, we're going to talk about what's in it for people. And this affects everybody in this room. The standard deduction, if you know when you're preparing your tax return on the front page, we're taking all of the income items that you have. You know, wages, your K-1 income, your dividends, your interest, retirement plan payouts, whatever, stacking it all together. And then the next decision or the next part of the tax return is, do you itemize or do you take the standard deduction, right? Well, in the past, if you were married, you used about a $12,000 standard deduction. So you took 12 and you could just strike that out of your taxable income, right? Or you could go over and you could pile up the things like mortgage interest, property taxes, charitable contributions, there's miscellaneous itemized deductions, medical expenses over 10% of your adjusted gross income. You pile all that stuff together, and if it was more than $12,000, you were itemizing. Well, what they did is they instead of being 12, now it's 24 if you're married. So they made the bar much higher, so it's going to be a lot harder for people to reach the point where they're itemizing their deductions. Because your standard deduction now is going to be $24,000. I kind of like this, I guess. It makes mortgage interest a little bit less relative. There are probably a lot of people that are going to drop off as a result. I was looking across my clients, and with interest rates as low as they've been, you know, people are usually a family of four, I'd say, averages about $24,000 in itemized deductions. So they hit a sweet spot with the standard deduction. But again, they're getting rid of a lot of audit issues when they did that. But you know, there's the next line that comes in on your tax return after this is these personal exemptions. And that's where you take the number of people in your household, you and your spouse and your kids, and you add them all together, and then you multiply them by $4,000, and you got that as an exemption. And you strike that out of your income too. So a family of four, that's $16,000 you got to write off. Well, that provision doesn't exist anymore. They wrote that out with this new tax law, so there's no more personal exemptions. However, if you have kids, you do get a child credit, which is $2,000. They doubled that, and they made the hurdle for people to qualify for that a lot easier. It used to phase out at around 175 or so. And now it's only on income over $400,000 that you lose the child credit. So
Yeah, combine.
combine it, yeah. So the AMT, remember I talked a little bit about that before. They did improve it, changing the exemptions, and we think a lot of the AMT issues will be removed in people's tax returns because of the new higher standard deduction, because a lot of times what was driving AMT is when you had these tax favored items that got added back in. And we talked about the mortgage interest already. We talked about the miscellaneous itemized deductions. Oh, there's no more itemized deduction phase out if you've been limited to that. And I'm going to leave you with this on the personals. Alimony. If you pay alimony, the way the rule works is that you take a deduction on your personal tax return for what you pay your spouse, and so you don't have to count it as income. Then the spouse is supposed to put it on their tax return and pay tax on that alimony. Well, going forward, after 2018, if you have a new alimony agreement, if you modify your old agreement, if you pick up and look at your alimony agreement, if you do anything with the alimony agreement, you have to switch and use this new rule, which doesn't allow for, you can't take a deduction for alimony anymore. As long as if you have an alimony agreement in place, as long as you don't mess with it, you can continue to deduct it until it ends. And the spouse will continue to need to report it as taxable income. I gotta wonder how many people are out there right now who receive alimony. I think it would be advisable for them to try to negotiate anything in it. You know, remove the word "the" from paragraph 6, modifies the agreement and takes it away from being taxable income to the receiver. So just be watchful for that. If you're paying alimony, you don't want to mess with it right now. Just leave your agreement.
This year? Is that-
No, I gave them some time. It doesn't start until 2019.
So someone considers personality.
Yeah, it makes you wonder, right? Somebody's paying alimony that was writing this bill. They wanted to buy another year because all the other provisions
Start nothing to do with Melania, does it? I hope.
it's a little suspicious.
My good friend said, Trump's expecting to pay it.
Yeah, maybe. Yeah, so he's got to get it wrapped up though before the end of 2018 because after that, you know. So yeah, that's funny. Okay, we're done with the individuals here. Yes.
Just a question, because my CPA, based on these rule changes that happened just last year, he's like, look, some of this stuff might stick for a year, like that top line, right? Nobody has a crystal ball in this room, but how many of these things do you think will hold and stick for impact versus our temporary changes like that doubling on a personal exemption?
We are going to be living with these rules through 2025. All of the individual stuff has a sunset, and then we go back to the old way of doing things. The business deductions are a little bit more permanent in nature. Glyn?
I think something that came out with the Congressional Budget Office basically said in 2020, we're going to go in a deficit of over $1 trillion. And the impact of that, I think you have to seriously think about, and we'll talk a little bit more about this on a personal retirement basis a little bit later, but thinking about what that sunset provision would do for you, and do you want to maybe move things up over the next 5 years to 6 years if a situation arises that you can take advantage of? Because as we know, we can make tax cuts, but we're not so great at cutting expenses, right? So.
Okay, so we're going to move on to the businesses. This is the fun part, how the new tax law. Clearly, before before you think about business taxes, what about entity choice? I mean, what kind of entity should you be for tax purposes, for legal reasons? There's so many choices out there. I mean, there's partnerships, there's LLCs and corporations and sole proprietors, and it's very confusing. And as practitioners, we try to do the best we can to understand what the client's need is and what their long-term plans are, and try to help guide them, for tax purposes, in the best entity selection. But there are a lot of legal things to consider too. And fortunately, we've got a great business attorney with us here today. Maybe, Amy, if there's anything you could say about selecting an entity. I know it's not an easy question to answer, but
it really kind of depends on what type of business you are. But my general rule is the limited liability company is the most flexible. It's got the most limitations on your personal liability. As long as you're a multi-member LLC. Single-member LLCs have some separate issues. There's some, especially in the state of Florida, there's a lot of the ability to pierce the corporate veil and go after personal assets. So just be careful with single-member LLCs. But multi-member LLCs are certainly kind of what I go to. There's a lot of flexibility in the types of membership interest as well. So if you want to bring on investors, you can have different levels of membership interest, different membership levels. And then you've got the flexibility in choosing how you want to be taxed, right? So you can choose to be taxed like an S-corp or a partnership. And I think that kind of is my go-to. I think we're kind of short on time, so I don't want to go too deep into it, but I'd say that's my top choice.
yeah, thank you. That's very insightful. I tend to feel the same way. I usually suggest clients pick an LLC. And if you have a corporation, nothing wrong with it. That's a great way to be organized, and you're not missing out on anything special. But LLCs can, the nice thing about it is you can fire up an LLC, go run and get your bank account, start operating as a business, and then, oh, I forgot to talk to the tax advisor. go back and we can at least make some decisions before the end of the year on how you want to be taxed. So I guess there's
And
that
convert, I mean,
advantage.
later on in the stage of your business, you can convert from your LLC to a corporation if it makes sense.
Right, and that's it's not something you can do if you're a corporation and decide you want to be taxed as a partnership. You'd have to start over. Okay, let's through that. All right, what? This is the biggest highlight, one of the biggest highlights. There's a lot, but the write-offs that we get to take now as a business have increased a lot. When I first started into practice 20 years ago, there was this thing, Section 179, and it was a $25,000 limit that you could write off. So if you bought a piece of equipment, you're required by law to capitalize it, right, as an asset in your books, and then take a little sliver of it every year until it's fully depreciated. And in, say, 5-year period, you're not recognizing the entire expense at once, you're having to recognize it over a period of time. With Section 179, you just get to pull the whole loss right through your tax return. And they've increased this, and this is a permanent change. $1 million you can spend on new equipment and write it off through Section 179. The other, and a competing concept out there, is bonus depreciation. This became popular, again, thanks to President Bush back there for implementing this after the 9/11 attacks. We had to encourage businesses to buy new equipment, and they came up with this bonus depreciation where you get to write it off. You get to write off the purchase of new equipment, but then the rule was it had to be new. Section 179 doesn't require you to buy a used thing, a piece of equipment, and write it off through Section 179, but bonus, it had to be new. Now, they not only took the bonus depreciation up to 100%, but they also changed the rule and said it's just got to be new to you. So what wouldn't be new to you if you bought a piece of equipment, right? That's an intriguing question because, as it so happens, I've got a manufacturing client, and these guys they lease semi-trucks, a bunch of them, and cranes and forklifts, and they have all this machinery and stuff, and they like the leasing. They like leasing them. But at the end of the lease term, they always like to buy the equipment out. Their mechanics are familiar with it, they know how the machine works and its peculiarities or whatever, and so they'll buy them out at the end of the lease. That's not new to them. They can't use this write-off provision. Yes?
I'm working through some equipment purchases right now, and the way that everything is set up, we're doing a 5-year lease to own with a dollar buyout at
Yes.
the end of the term. I mean, how do you see that fitting into this?
How do I see?
I mean, just what's your opinion on that as far as leasing goes?
Yeah, I tend to. It depends on the the economics of the deal, because we always look at what does it cost you really to purchase versus what does it cost to lease. For a lot, and it kind of depends on the kind of business you're in, but a lot of times leases make sense, especially if you cannot afford downtime. If that piece of equipment goes out, you need it replaced right away. And my example with the manufacturing company, they'll have something there in an hour replacing a forklift and keeps their production going.
Well, I mean, as far as writing off the expense of the lease each month.
Yes.
And then.
And if you end up buying it in the end,
$1.
yeah, then now the dollar would be your basis in the property, so you wouldn't have much of a deduction.
Gotcha.
But I would still, if it's a bargain purchase, why not buy it, right? Or if you trade it in and buy another one, the operating leases you continue to deduct just like you would normally. So you'd get an expense for that every period. Whereas if you buy the equipment, you get the immediate satisfaction of the write-off of the whole thing. So if you had debt on it, you didn't necessarily go out of pocket for it, but you got a big tax deduction. So it's usually on a case-by-case basis. We always ask our clients, let us get involved in that decision, and then we figure out what's the best tax strategy. Okay, why do you need both? If you spend less than $1 million, why the heck do you need bonus depreciation? Or why do you need section 179 if you've got bonus depreciation? Well, keep in mind, again, used equipment can go through 179. Can't use, if it's new to you, rule on bonus depreciation. But I'll say this, if you are doing leasehold improvements to your property, you can't use bonus depreciation because that does, you can't, anything attached to real estate, bonus depreciation doesn't apply. You have to use tangible equipment. Section 179 has a write-off provision for leasehold improvements. So I think that's where you'd see Section 179 be helpful to you. Okay, so the next thing we're going to talk about is corporations, C-Corps. Probably most of you aren't C corporations, I'm assuming. But it's important for you to understand this because you're going to hear with this new tax laws whispers of you should be a C Corp. It's a lower tax rate. And I need you to if you take anything away from here is that it's a little more complicated than it looks. This is our old tax rate system. This is the one that was clobbering us in the global economy that we talked about earlier. 35% tax rate, but look how fast you got there. Over $100,000, the money between 100 and 335 was taxed at 39%. Overall, the effective tax rate in here is 35%. This is all gone now. We don't use this tax system anymore. So if you're Apple, GM, Ford, Microsoft, this is what your old rate system was. This is the new tax bracket. It's just 21% flat across the board. You make $100,000, you write a check for 21 and you're done. That's the way the C Corp works. One thing to point out is if you're a C Corp and you were used to, or you managed it to make less than $50,000 a year, you actually experience a tax hike. Otherwise, it's a tax break. So for C Corps, remember, they also pay state tax, right? Because if you're, in Florida, we don't have individual state income tax, but we do have corporate tax. You don't file a return if you're an S Corp or a partnership in Florida, but you do if you're a C Corp. And that's a 5.5% tax that gets tacked onto that 21. Corporations, no more AMT for them. That calculation gets yanked out of their tax return completely. The net operating loss carryforwards, it used to be you could apply 100% of whatever the loss was income for that year. Now you can only use 80% of, you can only apply an NOL towards 80% of the taxable income. No more personal service corporations. Those rules went off the books. It used to be if you had, for example, as a CPA, if I was organized as a C Corp, my tax rate was 39.6 on every dollar of income. It was the highest prevailing rate for corporations, and they did away with that rule. So because now they have the flat tax, and that's the highest prevailing rate is 21%. I won't get into tax provision write-downs. If you were a company, this one is important. Used to be if you had $5 million, and depending on the kind of business, maybe $10 million in sales, you had to, if you were a reseller, you had to. They forced you to use the accrual method of accounting, right? Now they moved that hurdle up to $25 million, so it's easier to stay cash basis. And why that's important is if you send a bill to a customer, right, and they haven't paid you for it, under the accrual method, you got to count that as revenue and pay tax on money you haven't even collected yet. Seems ridiculous. Well, in cash basis, you're not paying the tax until you got the money and the wherewithal to pay the tax. So and it used to be you'd trip over that. Most companies did at around $5 million in sales, and now that's moved up to 25. A little bit easier. We talked about the interest expense limitation. You need professional help in evaluating that. All right, we're going to go on to, let's talk about pass-throughs. Pass-through organizations, you know, they did all of these great things for C corporations with the much better tax rate. They did some things to help individuals. They needed to do something for the normal business, right? For the typical S corporation or partnership, right? So what they came up with was they came up with this section 199A that is a 20% deduction in your taxable income for certain qualified businesses. And if you're in this 20% tax write-off is for any of the entities, S corps, partnerships, sole proprietors, even if you have trust operating as a business. And the way it works is that to be a qualified business and meet this definition, it essentially means that you aren't a specified service. So basically you qualify no matter what unless you're a specified service. So what is a specified service? Well, a specified service, and I have to read this to you, is anything that's in so you don't get the 20% deduction if you're in the business of health, law, accounting, actuarial, performing arts, consulting, athletic, financial services, brokerage services, investing activity, trading, or dealing securities and commodities, or, if it's not one of those, or where the principal asset of the business activity is the reputation or skill of one or more of its employees. What the hell does that mean? I don't have any idea. We don't know. We don't know what to do with this.
Like everything, or they just categorize?
Well, what business isn't dependent on the skill of one or more of its employees? It's just nonsense.
The internet?
It's very frustrating. I think what we're going to see is a lot of regulations, or the IRS will come up with something to help guide us along in this process. But I can tell you now, I'm going to be very aggressive about this with my clients. If you're not in one of those categories up there, I want you to have the deduction, because this reputation or skill of one or more of its people is the silliest thing. I don't even, how do you implement that? And one other thing, architects and engineers must have good lobbyists. They got exempted from this rule. We're going to change ourselves from CPAs to financial engineers and try to snag this deduction. Hey, Jeff, how am I doing on time? Okay, thank you. Okay, so a walkthrough example, okay? This is how this deduction works. If you have, let's say you have a K1 that's $100,000, okay? And you have, after you put your K1 in and you put your other income sources and your dividends and your interest and so forth into your tax return, and then you take your standard deduction and all, and after tax credits and so forth, you end up with a taxable income of $130,000, right? But inside your tax return, you've got $50,000 worth of capital gains. So maybe your company sold some equipment or something, and you have a capital gain come through. The way this deduction works is it's 20% of the $100,000 from your qualified business activity, right? Or it's, but you have to subtract out the capital gains from your total taxable income. So we would have to take the 50 and subtract it from 130 to get to 80,000, which is your eligible income for this deduction. And then you'd multiply that by 20% to get 16,000, and 16,000 is the number that you would write off of the $100,000 K1 that comes in. And that's kind of how that deduction works. Now, let's assume your income is $315,000 or less. It doesn't matter what kind of business you're doing. It could be a service, it could be a qualified business, specified service, doesn't matter. Everybody gets the 20% discount. So if your taxable income is $315,000 or less, easy calculation. It's just whatever your net income was on the business activity times 20%, and you take that out as a deduction. If it's over 315, I'm talking about married, and it's half that for a single person. If it's over 315, but less than 415, you get a fraction of that 20% discount. So it phases out. If you're a specified business, so for like accountants, if your adjusted gross income or a lawyer, your adjusted gross income is $415,000 or more, you get none of that 20% discount. But if it's under that, you'll get a fraction of it, and if it's a proportionate fraction of the 20%, if it's less than $315,000, you get the entire 20% deduction. I would take you through some examples of this, but it's boring and confusing, and you just need to be aware of there being an allowable deduction for any kind of business, even if it's specified one or more of its employees are, important to the company rule. And you can make $315,000 or less, and you get to take the whole 20%. In between, anything over $400 in your specified service, you don't get this deduction anymore. In between, it's a little tricky. Now, the deduction is limited to 50% of whatever you pay employees for wages. So if you calculate your deduction and it's $20,000, but you don't pay your employees $20,000, it's going to be limited to whatever you pay your employees. So if you're a sole proprietor, right, and you're some fellow out there doing a business and you don't have any employees, you're not going to get this deduction because it's limited to the 50% of wages. Okay.
So 50% of what?
50% of the wages that you pay employees.
So the deduction has to be greater than the 50%?
No,
the deduction has to be...
let's say you had, you calculated out 20% of your income was $20,000, right?
Yeah.
If you paid your employees $30,000, right?
Yeah.
Half of that number is 15. So
Yeah.
your deduction is limited to 15,000 instead of 20,000.
Okay.
Yeah, it's like a ceiling.
Question on that. So if you have multiple members in an S corp, they take W-2 income.
Yeah.
Is that W-2 income count or no? So only non-members?
Only non,
Yeah. Now, if it's under 315,000, doesn't matter. But you get over 315, then it starts to matter. And one other important takeaway here is that let's say you're not an employee-heavy business, but you're capital-intensive. Real estate, you got a lot of real estate, right? You can take 25% of wages and that might be zero, plus 2.5% of the unadjusted basis. That means the undepreciated value of your assets. You multiply that number by 2.5%, and that would be your cap instead. So there is a way we can work it back in if you don't have wages, but you're capital intensive. All right, these are some examples. You'll find them in your workbook. I wish I had time to walk you through them, but I'd put you to sleep. The main thing to take away is that everybody's going to save money with this thing for the most part. I think it'll be helpful. Kick through this. The same rules apply for sole proprietors as we talked about. The tough thing for them is they don't usually have W-2 income. And, the CCorp, if you remember, I told you I was going to explain why that's not always such a good decision. I want you to think about this. if you had, you got a 21% tax bracket that the company pays, there's no such thing as capital gains in a C-Corp, whereas people get a 15% tax rate on capital gains unless you're in the highest tax bracket, and it's 20. But we get a favorable tax rate on capital gains. Corporations don't get that at all. They just pay a flat. They just treat all the income the same, and it's 21%. But also, you know, if you're an S corporation, you're used to taking distributions out of the company. You take a payroll plus maybe once in a while you take a distribution out. That's not taxable to you, whereas if you're in a C corporation, when you take out distributions, it's a dividend, just like if you got a dividend from Disney, it's the same corporate structure. You have to pay a 15% tax on it on your personal return. So it's 21% plus 15% on the distribution. And then if you're over 200,000, you're going to pay the 3.8% tax on top of that dividend. And then you also remember we have to deal with state income tax. So the long and short of this is, I did an example in here, but you can see quickly, you had 43% pretty easily on a C Corp after you get all done. So I strongly urge you, if you hear whispers of you should be a C Corp, to strongly challenge it, talk to your tax professional, have them run these calculations for you so you can see for sure. Talked about the cash to accrual already. We talked about if you're subject to uniform capitalization rules, those limits got increased to 25,000. Tax planning is advisable. You might, if you're in the process of developing a process or a business, a new product, software, whatever, you might be eligible for an R&D credit. That's free money from the government, and it's a very specialized area, but we have professionals in our firm to help. And then cost segregation studies. This is where if you're building if you have a land and building, some of that building may actually be part of your equipment. Like, for example, I have a client, they pour a slab. They kind of, by default, think that's a land improvement subject to a long depreciation period, but really crane's mounted to the thing. It's part of the equipment, and it should be depreciated faster, and cost segregation study can help you there. So basically what this is saying is, and I hope I've opened your eyes or maybe helped you understand a little bit about what's going on with the new tax law. The key takeaway is plan and to take some of these things into consideration, and I hope that I've enlightened you with that. And now I think Glenn maybe would like to speak a little bit about
I'm just going to make
planning.
2 really quick points, so just forget about the slides that are in there. Just don't
I
worry
am
about
so
that.
sorry. I know I ran over.
Yeah, you're good. You're good.
My
If
time.
you would put it back to that marriage filing jointly, because I think it impacts people enough that there's a couple of things about it in your retirement planning, your investment planning, that impacts you enough that we ought to talk about it real quick. I think it's like 13 or something like that.
Yeah.
What's happened is and Mike, you can give me a nod on this, but when you look at your tax rates, what you can take as a generalization from this is that you're going to get about a 3% reduction in your effective tax rate when you look at those, the way it's been stretched out and the way it's been handled, right? So, yes, a married filing jointly versus 2017 and 2018. So if I'm not going to give you all the reasoning behind this, but if there's one thing I can give you from a business standpoint that I would think of is Ross, okay? If I am in a situation where now I can take a tax rate of 22 or 24% on the bulk of my income, when that's the sweet spot of my income, I can go ahead and pay taxes. So think about having an ability to put an investment in Roth in your qualified plans for your employees and for yourself. If you don't have it in your qualified plan now, try to put that into your qualified plans, because what's happening now is we have the sunset provision. It's going to be in 2025. President Bush could tell you what happens to sunset provisions and why they're in there. The reason why they're in there is because the tax rates are too low for us to be able to sustain them. The deficits rise. We can't sustain those tax rates unless you have expense reduction, which doesn't usually happen. And so the likelihood of those provisions and sunset provisions coming up, if anybody's who's a poker player in here besides Gary, probabilities are very important. The probability of those sunset provisions being implemented are very high. So we have a little bit of a window. So between now and 2025, if you have the ability to put stuff in a Roth at 22% at a tax rate or 24% at a tax rate, and then all of a sudden you're going to go back into the 35% tax bracket potentially down the line, that makes that, from a retirement standpoint, something that you could utilize and be helpful to you. The other thing that it's going to happen in regard to retirement assets and where people are going to look at is we've always had three pretty distinct buckets. You got tax-free, you got tax-deferred, and you got taxable, right? That's going to get, that's, at least if the provisions don't happen, that's getting merged a little bit. So the quality of your investment starts to matter more than the tax benefits of this, because now your tax brackets are, the difference between your capital gains rate and the rates that you're going to pay on ordinary income tax truly start to combine a little bit. And also you need to look at what investments you have, because the one that probably gets impacted by far the most in this are municipal bonds. What happens to the tax effective yield of municipal bonds when your tax rate goes down from 35% to 24% or 33% to 24%? All of a sudden those muni bonds don't look so good. So states, municipalities have got to start worrying about issuing those and the impact of that. And we're going to have to wait and see what occurs with that. One last thing to leave you with too is, from a business standpoint that really isn't impacted by this, but something I always try to get across to people is if you're in an exit strategy with your business, start thinking about what you're going to need in retirement and what your personal goals are, and quantify that to be able to fund it, and think about that before you sell your business, because it might impact when you sell your business, whether it's now or whether it's 2 or 3 years from now, whether those things that you want to do afterward are going to be able to be funded or not. So think about those things prior to those sales. Anything on the investment side or taxes I can kind of address for you, but that to me is the one thing to think about. Ross and how the tax rate changes impact your investments. Any other questions? I'm going to leave it to Amy to talk a little bit of how it affects you from the state side.
Okay, yeah. So just real quick, from an estate tax perspective, the transfer tax exclusion amount has been raised from $5 million to $11 million per individual. Married couple with portability can exclude up to $22 million in global estate assets. And so what I'm hearing from my clients is, well, who needs to do tax planning now that that threshold is so high? And just to remind everyone that, again, that sunsets in 2025, and so the rates will go back to, or the exclusion amount will go back to $5 million per individual, and $11 million for a married couple with portability. So planning still needs to be considered, and with administrative changes or administration changes, law changes happen, and so that rate or that exclusion amount could continue to go down. Even lower than $5 million. So just keep that in mind. The annual gift exclusion is $15,000 per year per individual, so that's gone up $1,000 for this year. And then just generally, I think as business owners, everyone needs to think about estate planning, but also business planning and what happens at the end of your business, kind of like what Glyn was saying. But not just planning for the end of your business, but what happens if something happens to you or your business partner, somebody becomes disabled or incapacitated? Do you have a buy-sell agreement? Do you have something in place that can kind of step in and help you transfer that business when it's appropriate time to do so? So I think that's kind of all I got in a nutshell.
All right. Oh, questions?
I just have a general question going back to the sunset provisions and, the whole intent of lowering the tax rate. I think I heard numerous times that lowering the tax rates made us more competitive globally. That's why we did it, and we're kind of in the middle of the pack globally. So, A, why would the sunset provisions, why would that occur? Secondly, I think it was Hank Fishkind or Sean Snaith, I heard them speak recently, and they said, good luck to the politician that runs in 24, 25 with the intent of allowing the sunset to go back versus continuing on with the new rate. So given we're now where we should be in a global market, why would it go back that high?
Phil, I think you distinguish, when it comes to the corporate tax rate, there's, on both sides of the aisle, there's an agreement, I think, that truly needed to be done, and I don't think that's, I would not be bringing up the sunset provision in regard to that. I don't think that's gonna happen. But you have to remember that it's kind of like a non-response letter, right? All you have to do is have gridlock for those sunset provisions to take place. You don't have to be a politician running on it. All you have to do is create gridlock to let it happen. And are we good at gridlock?
Okay.
My understanding of what happened with that is he had enough votes in the House, but when it got to the Senate, and they had to reconcile the bill to meet the Senate's needs, they had to have like a supermajority or something, a 60%, and they just didn't have the votes, and the only way they could make it easier to get it accepted by the Senate was to make some of these provisions expire. So it was, I think, a lot of driven politically.
And deficit.
And
deficit. I mean, without a doubt, it's deficit.
Isn't our debt gonna, by that time, based on the lowering of taxes, our debt's gonna be?
Well, now,
extremely
I will say this, they're filling the hole in some other places, and we didn't touch on it, but if you're a corporation that has money hidden, you're not hidden, but over in another country, right, and you've earned it all over there, not paid any taxes, the IRS hasn't, or the Congress in their rules passed a provision that requires them over a period of 7 years to reclaim all of that back, 5 or 7 years, to reclaim it all back as income. And then going forward, they're taxed on global income, so it doesn't matter where the money is, you're gonna be taxed on it anyway. So, and there are tax forms that they've got in place where they can sneak up behind the companies and hit them with a tax on that form because of the filing requirements, information returns they filed in the past. So, but I didn't go into that because I ran out of time, but I think they have some other ways to try to fill the hole. And that's one of them.
Question on a single-owned LLC membership versus multiple, of course, personally. You know, my consultant at that time, CPA firm, business coach said, in that case, the way it was protected is by tenants of the entirety. In a different status, is that still play, or is that not as strong as multiple members of an LLC?
So do you own the LLC as tenants by the entirety? So then you're not a single member because you're owning it with a spouse?
See, I was understanding I'm still a single member, but in protection, all assets could be transferred to whomever I choose in that tenants by the entirety. Is that wrong?
I don't know that it's wrong, it's just, I don't know that it's.
It was from protection more, you know, it was double protection. If something would be happening to the organization. The reason I ask is because you're here.
Yeah, no,
And it's
I
free
get it.
advice, so I.
Right, no, I get it. And I'm happy to talk one-on-one with you about the specifics of it. I don't know that it's wrong. And the single-member LLC, I think you just have to be cautious with it, making sure you're treating it like a business. You've got an operating agreement in place, nothing's commingled.
All that's done.
And the tenants by the entirety part, I'm not sure that that's really applicable, but it's there if
Okay.
your spouse is a current owner, but.
She's part of our company, so.
Okay, all right, well, that helps.
Okay, I will be happy to grab your card later.
It's a good idea.
All right. All right, thank you. Appreciate it.